The average Toronto condo costs nearly 50% more than it did in early 2021. That is one of the headlines that has caught some buzz in Toronto and the GTA over the last day. An article was released by the Daily Hive that goes through the current rental costs in Toronto and how much they've actually increased since early 2021 because we saw a drastic price pullback as a result of the pandemic. So, in this particular video, I'm going to go through some of my favorite points in the article, whether I agree or disagree with them. And then what I've tried to do is present a very unbiased approach to whether continuing to rent makes sense and what the cost differential is from renting to owning in each section of the condo market in Toronto. So one bedroom plus then, and two bedrooms. I tried to present this as unbiasedly as possible. I gave it a pretty evenly weighted score to figure out should you actually consider buying or should you continue to rent moving forward. My name's Emma and I run a real estate team in Toronto called Monstera Real Estate, and we help busy professional millennials build wealth through real estate strategically over time by moving up the property ladder with triple A quality properties. If you're watching this video and you want to get in contact with me, there's a link to book a call in the description below. And if you're new to the channel, I would very much appreciate a like and a subscribe if you find any value at all. So without further ado, let's get into the video. So the article starts by discussing the average Toronto rental price at the time of this recording, which is $2,963 when you take the average rental price across all property types in Toronto. Now, they compare this to the average rental price in early 2021, which was $2,100 for the same data sets or the same data points. And the reason that they've compared it to early 2021 is because that's when we saw the bottoming out of the rental price pullback that we saw as a result of the pandemic, right? So, if you remember during the pandemic, everybody moved out of the GTA because everybody was working from home. Nobody wanted to live in confined spaces, et cetera, et cetera. And now we've started to see mass movement back into the GTA because people are being asked to go back to work at least part time, gas prices are up, etc., etc. Now, the one element that they do discuss in the article that is the biggest component of driving up rental prices, you guys probably guessed it, it's interest rates. And so, if you look at any of the real estate investment gurus, they've been preaching this forever. They will continue to do so. And they finally had their point validated that when interest rates increase, so do rental prices. And the reason why that happens is because we have a large portion of the population that has been on the fence about purchasing versus renting. And when interest rates increase and prices continue to come down, a lot of people are like, there's too much uncertainty in the market. I'm just going to go and rent. And so what we've seen was the pent up demand on the buy side has subsided. Recently I've seen a little bit of a shift in the market, but that's for another video. But for the purposes of this video, we had a drastic amount of built up purchase demand. You guys know what the market was like in even February of this year, but we'll say for 2021, bidding wars like crazy, people purchasing with no conditions, all of that kind of stuff. What we saw was that craziness was removed from the purchasing side of things and it was injected into the rental side of things. So if you've talked to any agents that focus on rentals recently, you'll know that there are bidding wars. They're setting offer presentation dates on the rental in the rental market right now, and so that demand has built up in the rental market. So I just wanted to preface kind of why this is happening and what they've kind of discussed in the article. So the article they link to this average rent in the GTA report that was just released by TorontoRentals.com. It's actually a really great report if you're interested to know what's going on in the rental market in your particular area. Now, they go through the average rent and monthly change and average rents for all property types across the GTA. And then they go for average rent by number of bedrooms. And you can see here, this kind of validates what we were just discussing. We saw higher prices in 2022, and then we saw bottoming out in 2021, and now things have skyrocketed. And again, this is studios, one bedrooms, two bedrooms, three bedroom. They all kind of follow that same pattern. They talk about average rents per price per square foot, overall increases in movement in each region. This is the one that I really want to focus on for you guys particularly. And so this particular graph shows the average rent for condo apartments by month. They have select areas, and this is from 2019 to 2022. And so what you'll notice is the peak of the rental market pre-COVID was in August of 2019. Okay. And for the reason why I wanted to discuss this in this particular video is because this shows Etobicoke, Mississauga, North York, Scarborough, and Toronto, all of which are the areas that I would consider the most condo dense regions of the GTA. And again, in a couple of minutes here, I'm gonna go through a chart that I made you guys to dissect whether renting or owning actually makes sense. And so I wanted to show this for you to give you a sense of what the rental prices are like in your particular region of the GTA, and so that you can compare that to how much it's going to cost you to own and make an unbiased opinion of what financially makes sense for you. So in Toronto, in 2019, the average rental price was 27.15, and now you can see it's 29.63. The average rental price in North York was 25.13, and it is now 25.70. Uh, so the average price for North York was 25.15, and now it's 25.70. The average rental price for Etobicoke was 24.80. It's now 27.23. The average price for Mississauga was 24.42 and is now 27.67. And Scarborough was 20.69 and is now just shy of 2,500. So the one region that hasn't seen a massive uptick, or hasn't completely breached the peak of the market, is North York. Everything else is significantly above that peak. And so, if you're a renter that's looking at this video, you might be looking at different regions that may be more affordable for you. If you're an investor, here's a secret hack for you. What we will usually do is see what region has had the lowest pullback in comparison to what region has seen the biggest price jump from a rental growth perspective, and that's where we're going to start our search, because the numbers will typically look best in those regions, and that's just a secret hack to how we pre-qualify and find better deals more quickly for our clients. Okay, so let's go to this graph that I prepared for you guys. And before we get distracted on these two, let me hide these. If you guys do want a copy of this, there's going to be a link in the description below. Just sign up for it and I'll send you a copy, no problem at all. So let's look firstly at a one bedroom scenario. Okay. So when I was preparing this for my team, we did a vote to say, what do we think what are we still putting in offers for our clients that are looking in the one bedroom segment right now? What do we think is a realistic price? So 575 is what we came to a group conclusion on. That would be a fair price to pay at the time of making this recording downtown Toronto. Okay. And I took into consideration, just to let you guys know where the data came from, CO1 and CO8 in Toronto, which is it's comprised completely of downtown. So, south of Bloor to the lake, DVP to essentially Dufferin. Okay. But the bulk of the data points will be fairly close to the lake, where you're going to find most of the condo density. So purchase price 575, rental price 2600, 25 to 2600 is what most people are paying for a one bedroom condo downtown Toronto. And like I said before, if you've talked to any rental agents recently, they've likely been in several bidding wars for rental properties. So what this used to be like 1900 to 2000, and people are paying about 2600 or so for a one bedroom condo downtown. Okay? And there's a ton of demand for that at the time of this recording. So what I did was, here's the purchase price, here's the rents. All right, so we ran two scenarios here. One for those of you that potentially have 10% down, so 57,500, and then scenario two, those of you that have 20% down, which would be 115,000. Okay, so if you had $57,000 cash in your bank account and you went for a traditional 25-year amortization at current fixed rates, you'd be paying just shy of $3,000 a month for the mortgage. So the mortgage alone is more than the rental price, but I tried to make this as unbiased as possible to show you what the overall financial outcome is without making an emotional decision of just going, that's more expensive, this is better for me. Okay. So in this scenario, the mortgage alone, without taking into consideration maintenance fees or property taxes, is more expensive. We voted $500 a month for maintenance fees. If I'm honest with you, you're probably looking at somewhere between $420 and $550 a month, depending on the size of this one bedroom. So we landed at 500 to keep it fair. And then taxes, you're probably looking at somewhere between $170 and $200 per month for a one bedroom condo at this purchase price. These are again averages, but they're pretty accurate averages. Now, when we take all of these things into consideration, we get the total carrying cost. So the total carrying cost, if you've got 10% down, would cost you around $3,665. So $1,065 more per month, okay, to own the condo versus renting it. Okay. If you have 10% down. Now, if you have 20% down, your total carrying costs are going to be $3,250 per month. So it's going to cost you an extra $650 per month to carry the property. So if we times that by 12, it's going to cost you about an extra $7,800 if you've got 20% down to carry the property over the course of the year from a monthly carrying cost perspective. And at what was it, 1,065 times 12, it's going to cost you $12,780 extra to own the property versus renting it over the course of the year. So some of you are like, these numbers instantaneously don't make sense for my budget. I can only afford this. And maybe this is already very high. It depends on where you're at with your current financial situation. Now, if we just looked at this in solidarity and we didn't take into consideration the principal pay down that you would be getting after paying off the mortgage, and I'm not even taking into consideration the property appreciation or growth, all of these numbers assume that the price is flat and it doesn't increase beyond 575. If I'm being honest with you guys, I think we're going to end up, looking back in 5 years from now, and we'll probably end up having a little bit of a graph that looks like this on the rental side of things. And we're probably going to be somewhere in and around here at the time of making this recording, just from my projections. But again, it's a hypothesis. You guys can chew me apart in the comments. That's just my 2 cents. You don't have to listen to anything I say. I don't care. Whatever. So, if we take into consideration year one principal pay down, which means when you're paying off the mortgage, when you pay off your mortgage, a portion of it comes back as paying down the loan, and a portion of it goes to interest directly to the bank. The portion that I've taken into consideration here is how much money are you going to get back in your pocket from the money that you shell out for your mortgage every single month. So if you have 10% down of your mortgage payment of this 2980 that you're shelling out every month, you're getting about 980 back. So 2000 is going to the bank and 980 is coming back to you. So to me, there's less than $100 actual out of pocket differential for you to own versus rent the thing. So you're still slightly negative, but you're in the market, right? So if I have $100 variance above or below, I'm gonna put yellow here because to me it's like pretty flat. If you've got a 20% down payment, you're going to get $843 back of this 2,500 that you're spending every month, and the cost differential, remember we said, was 654. So your actual net benefit of owning the property is $200 per month if the property doesn't appreciate, and that's in your first year. And so, not to get too complicated, but your first year, every year you pay off your mortgage, you continue to get more principal paid back. The bank is smart. Okay. So when you go to pay off your loan, they're like, yeah, give me my interest payment first. You're committing to paying me interest over the next 25 years. I'm going to take the bulk of my interest first and I'll give you your payments closer to the end. So every year that you pay your mortgage down, you'll notice if you look at a mortgage amortization schedule. Okay, so to make my point a little bit easier for you guys to understand here, if mortgages don't make sense to you, this is kind of how it works with the bank. Okay. So your payments are going to stay the same across your payments are $2,200, let's say, for the purposes of this chart that I just randomly pulled up for you. The purpose your payments stay at $2,200 for the next 25 years as you pay it off. Now, the amount that you get back versus the amount that you pay to the bank, it it differs every single year going forward. But you'll notice this pink part is how much goes to the bank, and this part is how much goes to you. So at the beginning, when you start to pay your mortgage, you're not getting as much of your principal back. At the end, the bulk of your payment is all principal. So the payment stays the same, but how much you get back versus how much the bank gets back is in the favor of the bank at the beginning, and then you start to get the bulk of it. So you're probably looking about year 10, we'll say year 9 to 10, when the payments start to be even. So if you're paying $2,000 a month, 1,000 is coming back to you and 1,000 is going out towards interest. So hopefully that makes sense. I don't want to get too deep into the weeds, but I just wanted to clarify that for you. So I looked at two scenarios here when I presented this, what year one would look like. So it's a very clear winner. It's a very clear winner, and this should actually be yellow. So in year one, your principal pay down, every month you get 978 back towards your loan payment, which again is this, and the bulk goes back to the bank, right? In year one, if you have 20% down, you're getting the 843, and it's costing you an extra 650 a month. So you're netting $200 a month. So the situation is a net benefit for you to actually own the property, though it costs you more money every single month. Okay. From a payment perspective. So if you can weather the storms from a payments perspective, it might make sense to you. If the payments are too unaffordable and you can't make them, then you should probably keep renting. Let's look at the 5-year average principal pay down, because what I did was I took the overall principal. So this would be year 5. So I averaged out all of these payments because this one you're getting more and this one you're getting less. So I took what the average pay down would be if you're going to hold the property for 5 years every single month over the next 5 years, what the principal would be that you would get back. So in this scenario, I'd be like, you make the choice. Do you care about home ownership? Do you want to just keep renting? When it comes down to the payments and the net benefit cash flow, one way or the other, it doesn't really make a difference. If you believe in the market and you want to be a homeowner, and again, you believe in overall appreciation and growth in the future, then ownership still makes sense. But if you're like, I don't believe that, I don't think that that's happening in the future, makes no difference to me, then you're no better off, no worse if you're just taking this for face value and not taking into consideration any other variables. Now, on a 5-year hold at 20%, you're still netting $275 a month extra in your pocket financially. So then this makes sense if you're going to continue to keep the property. So I think overall, if you've got 20% down for a 1-bedroom condo, and again, I've done this for 1-bedroom plus dens, 2 bedrooms, and 2-bedroom plus dens, given the average price and average rents. In some of the scenarios, I actually don't think it makes sense unless you're getting a smoking deal where you're buying the property under market value. But in what I would say is, in most case scenarios, given current rents, current rates, if you've got 20% down, most of the time it makes sense. If you've got 10% down or less, it may or may not make sense. It depends on the deal. Are you getting it under market value? And do you believe in the fundamentals of the market? What's going to happen with interest rates going forward and the resurgence of prices now that they're suppressed, similar to what we saw happen with rents, right? So at the end of the day, that is my unbiased, as unbiased as I can possibly be. That's my opinion on how I would break it down from a logical perspective and how we've done it. If you found any value in this video, I would very much appreciate a like and a subscribe. And thank you guys for sticking around to the end of the video. I look forward to seeing you guys in the next one.